What the hell is going on with y'all? I hope you're doing good today. We are coming in with a heavy hitter on this first video that we are got an official setup, man. Like, this is legit. I got myself a MacBook. You looking at me through the iPhone camera, the iPhone 17 Pro, as a matter of fact. We got the lighting, we got the background, we got it all. And you know what? I'm gonna go ahead and give you guys a little bit of the sauce on how day trading works and go over the fundamentals. I'm super excited. Remember, my name's Jason, and I'm here to help y'all get profitable, get right with the charts, and get some motherfucking money, bro, at the end of the day. So before we get into any of the stuff I want to talk about, I really just want to, just explain to y'all what this channel is going to be, because this is the first video that I officially have the setup. Mainly, I'm going to be doing vlog style, one-on-one conversation type of content, and I just want you guys to really get the meat, the potatoes, the whole 9 yards from everything. Like, this is gonna be some crazy ass shit that you guys are about to be a part of, and it's only gonna grow from here. So this is day one, starting from the bottom, and we are just gonna climb our way to the top. Eventually, I want to create a community of people that can bounce ideas off of one another, that can really just get into this shit and have other people to talk with about it. Because day trading, the weird thing about it is the community is pretty large, but the people who do it, how the hell are you supposed to know, other than the internet, how to find these people? I mean, you might run into someone, have a homie who does it, whoop-de-wop, wadoo, whatever, but as far as like the actual group chats, man, I want to build this shit all the way up. So if that sounds like something that you're down to be a part of, put a comment below. Tell me what kind of strategy you're using to trade with. Tell me what markets you're trading in. Let's just talk it up, man. Chop it up, do the whole 9 yards, and get into it. But without further ado, I'm gonna go ahead and show you guys a couple of things regarding the slideshow that I created, and we'll get right into it. Right on. So the day trading basics. If you want to go ahead, reach out to me, follow me on TikTok, follow me on Instagram. I'm going to be putting a whole lot of lifestyle content on there, day trading content, everything that you guys would want to see regarding this type of stuff, and also just some stuff regarding like the videos I post in the future. If you want to keep up to date with it, that's my ad at the top. Go ahead, look me up, follow me, do what you got to do. The first thing that I want to talk about as far as the charts go, we know they go up, we know they go down, and this is just called price action. But what actually dictates these things is going to be two things. You got supply. This is going to be how much of whatever you're trying to buy is available. And then you got demand. Demand is going to be how badly do people want the thing that you're buying or the thing that you're trying to sell. Now, I want you guys to think about this in a very simple way. If you go to McDonald's, you go to Taco Bell, water is free. You can get the water cup, walk out, you don't got to pay nothing. Now, that's because water is abundant. And at the end of the day, even if you're not getting it for free, water is relatively cheap. We need it to survive. It's an essential aspect of just living. But if water was to disappear one day and we had barely any of it left, let's just say there was 100 bottles left in the world and that's it. Well, now all of a sudden, there's a lot less of it available and people need this to survive. So obviously they're going to want it pretty badly. Price of water would skyrocket, maybe even become priceless to the people who have it, because you don't want to die. These are going to be the things that dictate price. Now, that's an extreme example, but you can relate that to how the markets move with how badly do people want it, the FOMO, the supply, because every stock or crypto or anything that you're trading, there is a cap on it. You can only get so much of it. So the closer that you get to the amount that's even available on the market is going to also influence the price. Now, when it comes to what you can trade, there's 4 different categories in markets. The first one we're going to go over is Forex. Now, what Forex is really simple. It's basically just currency. Dollars, yens, euros, all that type of stuff. These markets are going to also be open 24 hours, 5 days a week. So you have a lot of time to trade in them, but the thing with Forex is that they don't really fluctuate that much in price because currencies are relatively stable. Now next, you also can trade stocks. Stocks are going to be open 6.5 hours, 5 days a week, and the market's open 9:30 New York time and they close 4 o'clock p.m. Now, stocks are a lot more volatile. than Forex. These are going to be a good option to trade if you're into, trading stuff like Apple, Microsoft, Tesla, Nvidia, NASDAQ, all those fun things. You've probably heard of a lot of the companies already, and this is just one way of trading. Another market you can get into is futures. Now, futures are basically going to be resources. The resources are going to be oil, corn, gold, silver, pretty much anything in that realm. And these markets are also open 23 hours, 5 days a week. Now, crypto is my favorite. This is the one that I trade, and it has a lot of volatility. Now, you're going to have people who like crypto, you're going to have people who hate it, but it is the only market that's open 24 hours, 7 days a week. It never closes. It is just, you're for the wolves at this point. You get into crypto, it's going to take you, chew you up, spit you right out. There's a lot of money to be made, but there's also a lot of money to be lost, especially when working with something as volatile as cryptocurrency. Now, Bitcoin and Ethereum are going to be the two major ones, and then you got a bunch of shit coins. Those are also just going to be, rug pulls. A bunch of stuff can happen with those. We can get into that later. How do you even access the charts? The charts themselves, and I'm going to go ahead and just move this. The charts themselves are going to be through TradingView, and or the one that I use is an exchange called Blowfin for cryptocurrency. So if you plan on trading anything that's not crypto, I would recommend just go through TradingView. If you plan on trading crypto, go through Blowfin. It's a really easy, user-friendly experience as far as loading money onto it. And then you can also learn how to transfer into a wallet to take the money out and put it in your bank. But Blowfin also does not use KYC for a limited amount of money. I think it's up to like $20,000 before you have to actually use KYC. So either of these are really good options, but again, Blowfin is only for crypto. TradingView is for, you can trade crypto and pretty much everything on there. So up to you on which one you want to use. This is going to be a view regardless of what website or exchange you're using. This is what you're going to see. A chart with some red candles, some green candles, and then the order book on the side, which is just the book of the buyers and the sellers, which is how we come to the conclusion of whatever price we're at. If you look at it, we can actually see that right now we're at $90,531.50 on Bitcoin, but the buyers and the sellers are buying and selling at prices very close to this, and they kind of meet in the middle. So whatever is the highest price that people are, buying at, and the lowest price that people are selling at is going to be right in between there, the actual price of Bitcoin itself. Candlesticks, these are going to be the red and the green candles that you saw on the previous screen. I want to break it down and explain to y'all how to even read these. A green candlestick is known as a bullish candlestick. This is one that opens and closes above the position that it opened at. So you're going to see these as green. And then you also have the body, which is the box of the candlestick in the middle. And then you have the wicks. The wicks are going to be these lines that are above and below. And what this means is that buyers or sellers, depending on the candle, got to a certain price and then pushed in the opposite direction. So wherever majority of that movement is going to be the body. This is that box that you're looking at. Wherever the price might have reached and then retraced back is going to be the wick. Now the exact opposite is for bearish candles. It's just when the market in a specific time frame for a candlestick opens at a certain price and closes lower than the price that it opened at. These are going to create bearish candlesticks, and the same exact principles apply where it can touch a certain price, retrace, and majority of that movement is going to be in the box. And we actually have a couple different candlesticks that are going to look, different, of course. The first example that you guys just saw was a very perfect candlestick, but the market's not perfect. And so bullish candlesticks can come in all different shapes and sizes. The most bullish candlestick you're going to see has no wick at all. It's just a body. It starts low, ends high, and it just goes. The next one that we can see is the normal bullish. This is where price starts lower than it closes, right? And maybe it even goes pretty far down. It gets pretty low, and you're looking at what would be a red candlestick while it's in this wick area. But before the candlestick closes, it goes up above where it opened, and that's why you see the small, tiny little box, what we're going to refer to as the body, at the top of this wick, and this indicates very strong buying power. Now, price went all the way down to the bottom of this candle, pushed all the way above where it opened, and that's why it has this weird, we'll call it a hammer look to it. But yeah, indicates just strong buying power. Normal bullish candle, we already went over that. That's just like the first one that we saw, where the body in the middle is majority of that movement, and then we got some tiny wicks at the top and the bottom. Now the neutral bullish is going to be where price goes up, price goes down, it ends up closing just barely above where it opened, but relatively similar in price, so it didn't move too much. And these indicate that price is not really moving. The buyers and the sellers are pretty much even at this point. And then we have the least bullish one. Price tried to push up. It couldn't sustain it. It still closed above where it opened at initially, but buyers were not strong enough to keep pushing the price up. So you see this long wick at the top on the very last candle, and this is going to indicate buying power is starting to slow down. As far as the bearish candles go, exactly the same, except opposite. The most bearish candle you're going to see is where it opens at the top, shoots down, doesn't retrace at all, and it closes below where it opened at. And this is the first example. No wicks, no nothing. The second one is going to be where price tries to go up, gets shot back down, and actually closes below where it opened at, creating a red candle. It has a long wick at the top, but majority of that movement and consolidation, where the buyers and the sellers were, was at the bottom. So this is going to create a bearish candlestick. Now, normal bearish, we already went over that too. Neutral, same thing. Price tried to go in both directions, closed slightly below where it opened at, and then didn't really move too much. So it doesn't indicate that buyers or sellers are very powerful in either. So the least bearish one is going to be where price went all the way down, pushed all the way back up, creating this wick that you see at the bottom, and because it closed slightly below where it opened, it's going to have this tiny body at the top. This is indicating that the selling power is slowing down and the buyers are starting to step back in during this candle. Now, when you're putting in your trade, you're going to have market orders and you're going to have limit orders. These different orders are going to indicate when you get into the market. So if we take a look at the top one, you can see the market order. This is when you enter the market exactly at the price wherever it's at. So in this example, on the right side of the screen, price is at $90,644.70. If I was to put a market order in and enter at that price, immediately my money is going into the market, and that's where it is. Now, the limit order is pretty unique because instead of going immediately into the market and putting your money in at whatever the price is at, you can actually choose to wait. So if price is at $90,644, I can say, well, I want to wait until price goes down to $90,000 for my money to enter the market. And you can enter a long or a short position, which is basically going to say you think it's going up or down. Now, when you're putting in your trade, make sure that you are clicked on isolated, because the default setting is going to be cross. Now, the difference between the two is that when your positions are in cross mode, your positions are going to share the same exact balance. And I want you guys to think about it like this. If you have $1,000 and you're trading with that, let's say you're trading on Bitcoin and you're trading on Ethereum, you can put $1,000 into Bitcoin and $1,000 into Ethereum, even though you only have one. You're trading with $2,000 positions, and let's say Bitcoin goes up. You're making money. You're looking good, but Ethereum goes down. Well, if you lose all your money on Ethereum because of this cross option, you're also going to lose all the money in Bitcoin because they share the exact same pool and it takes from the same place. So if you lose all your available balance on one, you lose it on all, and they're cross with the balance that you're using. Isolated, however, is isolated to each position that you're trading. So if I have $1,000, I can put 500 into Bitcoin and I can put 500 into Ethereum. And if the same thing happens where Bitcoin is up and Ethereum, I lose all my money, well, I only lost the $500 in Ethereum, but it is unaffected as far as my Bitcoin trade goes. So the money and the trades are completely separate with isolated. I highly recommend that when you do start trading, you do isolated, because cross can get super confusing, especially in the beginning. Now, putting in your trade, like we talked about before, a long position is entered when you think that the price will go higher. This is going to be that green button that you see at the bottom. And then a short position is held when your prediction is that the price is going to go lower. Now, that's going to be the sell short button that you see at the bottom as well. Take profits are going to be a box that you can use to set a specific price point where you want to automatically pull out of this trade. So in this example, we enter the market at 90,000. We put $1,600 into the market, and then our take profit is when price touches 91,000. You can actually see right here, we're gonna make $17.17 off of this trade and automatically pull our money out because of the take profit. We don't have to look at the charts. We don't have to do anything. It's already set in stone because we have this take profit. Now the stop loss is gonna be the exact opposite. When you have a stop loss, it'll automatically take your money out of the trade to prevent you from losing more money than you have to. And in this example, if price goes down to 89,000, we enter it at 90, we end up losing $17.70, automatically takes it out of the trade, so we don't have to click it, we don't have to do anything. And this is gonna be like a fire extinguisher. If there's a fire going on, you wanna put it out, this stop loss is going to help you prevent further damage from going to your account. Now, putting in your trade, there is the option of using leverage. Leverage is going to increase the margins that you make on each trade. So, for example, in the first one, we made $17 if price moves up $1,000. In the second one, we're going to use a 10x leverage, same price, we enter at 90,000. If it goes to 91,000 and we predict that it's going to go up, then we make, instead of $17, $177. And the same goes for if we lose money, we're going to lose $177 instead of $17. And you can go up even to 100x leverage. And 100x leverage is going to be pretty much the same thing on a bigger scale. If price moves up $1,000, 90 to 91, or even down $1,000, 90 to 89,000, well, we're not going to lose or make 17 or 177. No, we're going to make or lose $1,777, so long as we have enough money in our bank account to do that. Now, when it comes to leverage, you can't lose more money than you have, and this is why we're going to get into the liquidation points of it. So liquidation happens when your entire account balance is depleted. And this typically happens when you're using way too high of a leverage. I would recommend using no leverage, especially in the beginning, because you're just trying to figure out how to stay consistent. Maybe once you get a little bit of consistency, like what I do is I use 10x leverage, but I will never go above 10x. That is my absolute maximum that I will ever use when trading. Now, liquidation happens when your entire account balance is depleted, and it actually gives you an indicator on where that liquidation price is going to be. So if you're not using any leverage, then liquidation, if you think price is going to go up, would have to be 0. Like the price would literally have to go down to 0 of whatever you're trading for you to lose all of your money. However, if you have 100x leverage on a trade, and you're, putting, let's just say the same amount, $1,600 into the market, and you enter at 90,000, and you say that price is going to go up, but instead it starts going down, the only wiggle room that you have is for price to go down to $89,422 before you are completely wiped out. And the same is in reverse. If you think price is going to go down and you enter in a short position, but price instead goes up, well, since you entered at 90,000, if it goes to 90,574, you are completely done. You lost all your money. All $1,600 is gone. So the more leverage that you use, the less wiggle room you have. And this is why it's very, very important not to over leverage your trades. And that's the whole basics of everything I wanted to go over with you guys. I really appreciate you if you made it to the end of this video. You are amazing. This is the beginning of an awesome journey. Like, I can't wait to see how this is going to turn out for all of us. Like I said, I want a huge community of people who are just down to bounce ideas off of one another, and you could be a part of that. Let me know what you learned off of this video. If anything, drop it down in the comments. Hit me up on Instagram, hit me up on TikTok, follow me if you want to keep up to date with everything that I'm going to be posting for you guys, because at the end of the day, this is what it's all about. I want to see you succeed. I want to see everybody just get out of that rat race that we all live in, where it's minimum wage jobs and all this bullshit, man. Like, there is another way to make it all work, and I want to bring as many people with me as possible. So remember, my name is Jason. This is the type of content I'm going to be creating over and over and over again, and it's only going to get better from here. I hope to see you guys in the future. Be safe, and I'll catch you later.